Hi there, welcome to The Close. I'm Lindsay Biscaya in for Morella today. Markets are closing in half an hour from now. So first, let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Traffic through the Strait of Hormuz is seeing an increase, with 21 ships transiting over the weekend. The increase is the highest level in weeks, and it's due to countries securing safe passage deals with Iran. The country is granting exemptions to select partners while advancing legislation to formalize transit fees. And shares of Barrick Mining are trading lower today. The miner is slowing development of its Reko Deep project amid escalating security risks in Pakistan. The company says it will scale back spending and extend its project review until mid-2027. Barrick still sees long-term value in the project, but warned costs could rise from earlier estimates for Phase 1. And Toys R Us Canada is battling tech giant Acer along with two other businesses over trademarks that it says will cause confusion with its branding. The three firms filed applications to register a backwards R as trademarks. Toys R Us is opposing the use of names and symbols linked to its brand. The toy retailer remains in creditor protection as it searches for investors for its business or buyers for its assets. And we'll take a look at the markets this afternoon. The TSX is up ever so slightly, pretty much unchanged. It's an interesting day for the markets. Seems as though investors are feeling a little more optimistic on this Monday that maybe there could be an end to this war in the Middle East sooner rather than later. Obviously, we'll have to wait and see. U.S. markets mixed trading today, but it looks similar to the TSX at the moment, all currently in the green. And we'll continue to watch that for you throughout the afternoon. Meanwhile, for more on investing in macro-driven markets, joining us now is Adam Chilio, portfolio manager at iCube Investments, Guardian Capital LP, and he joins us in studio. It's good to have you. Thanks for coming in. It's been an interesting, I can't believe it's been really 6 weeks since this war in the Middle East broke out. There's been so much volatility in the markets. From where you're standing, it's so hard to know what's coming up next, but do you expect that volatility to continue? Yeah, we do. It seems the news, both good and bad, is coming out on the same day, almost even at the same time, and to make heads or tails of where it's going to go is fairly difficult beyond the next few hours. We think in general, obviously oil prices have gone up due to the war. That's feeding through to inflation's expectations. We've seen it a surprise to the upside in February. And now there's thoughts that that would be stickier for more medium term. And then of course that affects rate expectations. There's thoughts will be fewer rate cuts or rate cuts pushed out further in time. So there's some inflationary signals there. You're seeing more anecdotes now from on the employment side. Oracle recently announced they're laying off 30,000 workers through an email. Negative employment outlook is kind of deflationary, so it's a bit of a mixed bag. And then on the flip side, you still have earnings expectations for the overall S&P going into earnings season is still expected to be double digits year-over-year growth. So mixed bag. It seems to be that inflation isn't really dead and growth is still not collapsing. So if you were to what we would focus on mainly is companies that generally have stable margins, strong balance sheets, or just general earnings resilience. I do want to get to those because I know you do have some stock picks and some areas that you like. But just first of all, as you mentioned, there doesn't seem to be just one factor really that's driving this volatility, right? There's quite a few. Is there something that you think maybe the price of oil, I'm not sure, that's driving this volatility a little more than others? Yeah, I think so. I think it's just mainly the news out of the Middle East and not really knowing where that's going. That and more on the company-specific side of things, I think the focus is more on the ongoing issues with the AI build-out, and there's positives and negatives from there as well, so they're interacting. That's what I want to talk to you about next, your outlook for the huge run-up in AI spending that we're seeing, particularly with some of these companies. Some of that big spending that was announced didn't really sit well with investors at first. Where do you see that going? Well, one example is we look specifically at Microsoft, and yes, I know they are down this year, but currently they're trading, I think, well below their median price to earnings over the last 5 years. And the focus on them again, yes, is the whole AI build out, and there's multiple issues there. There's a lot of the investments in infrastructure for data centers is debt fueled. You have the issue of continuous increasing demand for GPUs. There's the issue of power generation, and then also power accessibility. So you not only have to build out the power, you have to build out the infrastructure to get it to where it needs to go. That's a whole other problem to solve. So companies like Microsoft and other hyperscalers are becoming a lot more asset heavy and capital intensive. So
a lot more CapEx going on. I think their CapEx is up about 65% year over year. And so there is some cash burn and it's affecting their margins. But we take a little more of a longer term outlook at their overall cash flow strength and their cash flow growth. And I believe amongst the other hyperscalers, they're one of the few that's still expected to grow their free cash flow in 2026. And while, yes, there's been more AI spend on infrastructure, the bulk of it is still anchored towards their cloud software and services, a lot of their high margin services. So their main earnings driver is still their intelligent cloud, think like Azure AI compute. And that segment is still up 25% year over year for revenue. So for Microsoft, at least, we have still a positive outlook.
That's one of your picks that you like.
Yes.
So we'll go through the others now too. Analog Devices is another one. Like, what do they offer in terms of the digital world?
Yeah, they're a little bit of a diversifier away from, say, the whole AI build-out data center theme. And we like them. They have a very broad portfolio across industrial automation and automotive. And their revenue growth has been very strong as well. It's up about 17% year over year to roughly about $11 billion. About half of that is industrial and 3.5 is automotive. And being producers of analog signal devices, so think things like various types of sensors or power management systems and things like that, those products tend to have very long life cycles and are needed to be very durable, generally because we call them edge use cases of a semiconductor. Okay. So they're not sitting in a clean data center that's air conditioned. It's sitting in a hot factory or it's in a moving car, an underwater device. So long life cycles and the overall cycles for capital expenditure in that space are generally drawn out over a longer period of time. So it's easier for them to manage their inventory. And as a result, they tend to have very high margins. I believe their gross margins are almost 70% and their operating margins are about 42%. So just overall, they're very capital efficient.
Another one that you like, and then we'll get to one that you got out of recently, but another one you like is discount retailer TJX.
Yeah, we call them one of our sleeper stocks.
Why is that?
Meaning it's underrated and it doesn't get the attention that it deserves. And you could argue from the perspective of a portfolio manager, that's a good thing.
Okay.
While our general outlook on the earnings for the retail sector is a little weaker, TJX stands out because they are the dominant off-price retailer. And given their business model where customers are shopping for discount apparel and goods, like in a treasure hunt format, we think most people appreciate that experience. And overall, we just judge them mainly on their earnings quality. So if you look at the stability of their cash flow and sales growth over time, they're generally sector leading. And they have a very good ability to, they have low capital expenditure relative to their ability to generate cash flow. So if you look at their dividend growth over the last 3 years, it's been about 13%, double digits, and that's an annualized number, so 13% a year. And you're getting all that for very low volatility as well.
And look at that chart over the last 5 years, it's just been going up. Okay, I want to get to the last one that you got out of recently. Accenture? Yeah,
the issue we've been focusing on in general is more the theme of AI disruption in the software and services space, and Accenture is an example of that. We sold recently for us being middle of last year.
Okay.
And they're having to deal with the issues of AI disruption in their whole industry. And because we know that AI is disruptive and companies with some skill can do more with their own data internally with AI. So, they may not need, and they might be able to do it faster than a large embedded team of consultants. So then there's the question, do we need as many consultants to work with us, or do we need them for a shorter period of time? And those services are generally paid for their time. But more specifically, they're in a bit of we'll call it an AI paradox, where they're forced to fund their own disruption because companies like Accenture have to invest heavily into AI just to adapt or survive or find new avenues of revenue. And we don't really know how that's going to play out. They could have massive increased demand in revenue in the future, or they could be disrupted by startup software or services that have a lower barrier to entry now thanks to AI.
Yeah.
So AI has now become a valuation and earnings overhang for them. And it's just really difficult to put a number on the economics of it because it's easy to say, well, if we lose X contracts, I'm going to lose Y number of dollars. It's much more difficult to say AI is going to cost us Z number of dollars because we think it's going to change their whole, structurally change their business model. So it's difficult to map out, and that's one of the reasons why we sold it.
It's going to be so interesting to see which companies are benefited from AI and which are going to be, as you say, maybe made redundant. Okay, that's all the time we have, Adam. Appreciate you coming in studio. Thanks so much.
Thanks for having me.
That is Adam Chilio, Portfolio Manager at iCube Investments, Guardian Capital LP. Up next, oil prices rose today as concerns grew that the conflict in the Middle East may escalate further, while hopes for a ceasefire between the U.S. and Iran have diminished some. We'll be back in a moment with more. Welcome back. OPEC has agreed to increase oil output quotas by 206,000 barrels per day for May, which many consider to be a symbolic target with the Strait of Hormuz still effectively closed. So for more, let's bring in Bob McNally, founder and president of Rapidan Energy Group. It's great to have you join us. Thanks so much.
Thanks for having me, Lindsay.
Do you see this move by OPEC to be more symbolic than actually moving the needle at all?
Yes, but symbolism matters. I mean, this is an organization, OPEC, that met during long wars during the 1980s, and that they are meeting in the midst of this with Russia included in this group of OPEC plus, I think it's symbolic, but it's important. The most important real world thing that OPEC, or really Saudi Arabia, has done is increase those crude flows over to Yanbu on the Red Sea and provide a little bit of relief from the world's largest disruption now going on at Hormuz. So that's more important than the 206,000 barrels a day quota increase announced yesterday.
Why is that more important?
Volumes. I mean, what matters now is volumes. When Hormuz shut, we lost 20 million barrels a day of crude and products, about 15 of crude, 5 of refined products, LPG. And we were able to redirect, or Saudi Arabia was able to redirect 3.5, maybe 4 million barrels a day, from the Hormuz Strait, where it had been going out, over to the more lightly used Yanbu port on the Red Sea, where there are a lot of tankers lining up to get oil. So that just is orders of magnitude bigger than the 206,000 barrels a day of a quota increase, which is largely symbolic since that oil is really still blocked up in Hormuz.
Got it. Okay, so going back to OPEC then, because obviously, as you say, there isn't capacity right now to transport or store additional barrels. So if there's an increase in OPEC production, could that actually stabilize the markets at all, given all the factors that are at play here?
I'm afraid not. This is such a huge problem, such an unprecedented problem. The only solution to this is to restore the flow of oil and gas through Hormuz, ideally without having damaged critical energy infrastructure, terminals, stabilization plants that so far have been largely spared. That's the only thing that's going to stop this.
And with the Strait of Hormuz closed, like, which countries are still actually producing barrels, or have any countries actually shut in all their production?
Well, so Iran is the only country that is producing at pre-conflict levels, if not a little bit higher, and is no longer sanctioned and is making money hand over fist, given the high prices of oil in general and the high prices for its grades of oil in particular. So Iran is the only continuing exporter. The rest of those producers, Iraq, Kuwait, Saudi Arabia, UAE, they have had to shut in nearly all their production in some cases, a good deal in others. Saudi Arabia, as I said, is able to maintain production because it's redirected a lot of its crude away from Hormuz and toward the Red Sea. But others have had to shut in healthy amounts of production. And it'll take, in some cases, months, many months, to get all that oil back once the shooting stops.
Right, because I wonder what that production looks like right now, given the damage that's been done to so many of the infrastructure in those areas.
Right. So, well, we have, the deficit now, 13 to 15 million barrels a day that has been lost in terms of crude and products to world markets. So, for every country, it's different. Iraq, it's down by many millions of barrels a day. Saudi Arabia, less so, and so forth. But, that can be largely restored. Largely, I say, some fields in Iraq that are old and not able to be cycled up and cycled down, they may suffer permanent loss. But then you have some fields in Saudi Arabia, perhaps, where resting it, if you will, shutting it down, may actually restore pressure and energy and may be more potent when it comes back. So the real issue is the long-term production capacity, which is a function of which fields were brought down, how long, in what fashion, and then what does infrastructure look like when this shooting stops.
And just lastly, I know we were listening to U.S. President remarks today at the White House. I believe you were as well. I wonder what your main takeaways were from what we heard from Donald Trump today. And do you believe the U.S. will actually escalate the conflict if Trump's deadline is not met, that deadline being tomorrow?
Yeah, we're always a little bit cautious because, as we all have learned, the president can say different things at different times. But this time, he appears to be pretty serious about this ultimatum for 8 p.m. Eastern tomorrow night. And while he alluded to talks that were going on, supposedly in good faith, I don't understand that's the case. I wish I had optimistic information on my own side from Iran and so forth that we were moving towards a ceasefire. But I think odds favor, unfortunately, no ceasefire. The sides are too far apart. Iran thinks it's winning. And the president now, I think, to defend his credibility, will have to escalate if he doesn't get a deal by tomorrow. So I'm afraid the odds favor escalation here in the coming days.
Okay, we'll have to wait and see what that does for the markets, but we'll leave it there. Bob McNally, founder and president of Rapidan Energy Group. Appreciate your time. Thank you.
Thank you.
Coming up next, the U.S. labor market added 178,000 jobs in March. So we will share further insights on the factors behind this surprising growth right after the break. Stay with us. The U.S. labor market added 178,000 jobs in March, reversing the 133,000 decline in February, though the healthcare sector accounted for much of the growth once again. Let's bring in Oscar Munoz, Chief U.S. Macro Strategist at TD Securities. It's great to have you join us. Thanks so much.
Thank you for the invitation.
These are some interesting numbers. Like, first off, how do you interpret the significant kind of gap between the numbers we saw in February and the numbers we're seeing come out for March?
It's just a lot of volatility in the payrolls data, which kind of tells you that you shouldn't extrapolate from one single report, right? You were surprised materially to the upside in January as well. Then you saw that meaningful contraction in February, as you mentioned, and then another meaningful surprise to the upside. The way we read or evaluate the data is just look at the last three to 6 months worth of payrolls numbers and kind of take the average and see what's happening. You look at the 6-month moving average, it's been between 30 and 50K over the last 8 to 9 months. That pretty much tells you that's where the break-even pace is. So if you look at it from that perspective, we think the labor market is probably closer to a steady state, particularly when you put it together with the unemployment rate, which is also been running at between 4.3 and 4.4 over the last 6 months.
Yeah, let's talk about the unemployment rate next then, because it includes some discouraged workers, those in part-time roles for economic reasons. It's increased to 8%. What do you make of these numbers and where that's coming from? And does the recent rise in gas prices have anything to do with that?
I think it's too early for the increase in gasoline prices to be impacting the jobs report. Remember, the jobs report for March reflected a survey conducted in the week where the 12th of the month falls. So that's earlier in the month. I think it's too soon for businesses to be making, grand plans or change of plans in terms of hiring. I think that what the increase in the underemployment rate tells you, which is what you're seeing with, young workers as well, is that there is not a lot of demand for labor out there, right? You're seeing it in the jobs report. The hires rate continues to drop. The job finding rate is also dropping. So I think if you look at the whole data together, the mosaic of labor market data out there, including JOLTS, including initial jobless claims, what it tells you is that there's not a lot of layoffs, but it's also not a lot of hiring going on. That's why people continue to talk about a low hire, low fire labor market. I think it has continued at the start of 2026. So
do you expect that unemployment rate to maybe continue to climb?
We do expect it to move a little higher in Q2 on average to 4.4%. So on any given month in Q2, you could see a 4.5%. Remember, in the prior report, we were closer to hitting 4.5%. In the last report, we were close to hitting 4.2%. So that tells you a lot of the volatility that you're seeing in the establishment survey in payrolls. You're also seeing in the household survey, right? But we do think that on net, probably over the next few months, you will see a negative impact on hiring owing to the ongoing energy shock in global markets.
Wages also rose maybe less than expected. Did that surprise you at all, the numbers you saw coming out for wages?
Actually, no. We forecasted a 0.2% month-on-month increase for for average hourly earnings on Friday, so we're on the right side. I think that tells you that, again, the labor market is not really a threat for inflation going back to 2% over the next year. I think labor market conditions are where they should be. They're probably close to their steady state. Again, job gains running on average at around 30 and 50K on a monthly basis, in the unemployment rate hovering at 4.3, 4.4. So again, I think the labor market is not an issue for Fed officials when thinking about going back to the 2% objective. So that's why I think they will focus a little bit more on the inflation front over the next few months, given that the labor market is where it needs to be.
Okay, and since last April, too, like the U.S. labor market has experienced minimal hiring, though. When it comes to the hiring process, why do you think there's been such minimal hiring? Is it a shift in terms of the workforce, or what do you think is going on there and some of the factors that are driving that?
My view is, for the most part, is uncertainty, right? The incoming administration added to uncertainty at the start of last year with new immigration and trade policies. Our view was this year we were coming out of the woods on that front. We had a very strong view for the U.S. economy, but again, we see shifting geopolitical policies, and that's increasing uncertainty again. So it's a continuation of uncertainty. If you're a business and you have no idea where the economy is going toward the end of the year, last year, and toward the end of this year, it's hard to make a lot of commitments either on CapEx or on payrolls.
We also saw bond yields increase following the release of the jobs report. Do you think that the strong employment data could prompt the Feds to maybe consider a rate hike in the coming months?
No, I think for us, we actually have cuts for toward the end of the year. For me, is the bar for the Fed to hike is very high. You really need to see contamination or second round effects on the core segment. We're definitely going to see a jump on non-core inflation, on energy prices. You'll see it on Friday. We're forecasting the CPI to jump to 3.3%. So a very meaningful increase there. But they're going to pay attention to what happens in the core, what happens to inflation expectations. If that's contained, I think they can look through the shock as long as the labor market remains on hold and resilient. So I think in the near term, the Fed is going to stay on the sidelines, be patient and cautious. And I think they can't pound the table on any particular view. I think that's what we're going to hear from Fed officials over the next few months.
Okay, we will leave it there. Oscar Munoz, Chief U.S. Macro Strategist at TD Securities. Appreciate you joining us. Thanks for your insight.
Thank you.
Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. Winchester Bancorp rings the closing bell. At the New York Stock Exchange, Barton School of Business is ringing the closing bell. And at the TSX, Manulife is closing the markets. You are watching The Close on BNN Bloomberg. I'm Lindsay Biscaya in from Morella today. And here's how we close the day on Bay and Wall Street. A little more optimism amidst all this volatility over the last couple of weeks. The TSX finishing the day ever so slightly up. Same with the S&P 500. The NASDAQ up by 0.5% to end the day. If we take a look at some of the big moves of the day, we're obviously watching MDA Space very closely. Rated a new buy at Jefferies. But on top of that, MDA Space has also had a very big hand in the Artemis 2 space launch that we're watching closely. We're going to have updates on that later today. MDA Space finishing the day up more than 6%. They're currently building the Canada arm for that space launch for the next phase of it. And so MDA Space really doing well today, finishing the day up. Barrick Mining is another company that we're watching. It has announced that it is slowing down production at its gold and copper mine in Pakistan due to security concerns. And so Barrick Mining is down to end the day by 1.4% after this news. It says the review of this project will extend into mid-2027 at least. So slow production for Barrick Mining announced today. And then we're also watching shares of Tesla because JP Morgan cut the outlook for Tesla. It says the stock could fall up to 60% throughout this year. The stock fell today more than 2%. So we'll be watching Tesla closely to see what happens there over the next couple of days. Meanwhile, the timeline for de-escalation of the Iran war is still uncertain as the clock ticks down on U.S. President Donald Trump's deadline for unblocking the Strait of Hormuz. And for today, stocks and oil prices inched higher. So joining us now is David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. It's great to have you join us. Thanks so much.
Lindsay, it's a pleasure to be with you.
This is an interesting day once again. I mean, the markets still seem pretty optimistic that maybe this war in the Middle East could end sooner rather than later. Is that your takeaway from what you saw today?
It's really a seesaw here. I mean, on the one hand, if the Straits of Hormuz get opened and oil prices come down, that's going to provide a strong bid to stocks. On the other hand, if that doesn't happen, if you take Mr. Trump's words literally, it could be the last night ever in Iran. So it's really binary outcomes here. It's hard to know exactly what to make of it here. People were buying stocks today, even though, of course, oil prices did drift slightly higher today.
I wonder how U.S. consumers are reacting to $4 a gallon at gas stations in some areas of the U.S., especially with like the summer kind of holiday driving season picking up. A lot of people may be going on road trips. What's that reaction from U.S. consumers, do you think?
Yeah, people are not happy. It does depend a little bit where you are on the income spectrum. Obviously, the lower income people, the cost to fill up their tank is a much bigger share of their household income, while those at the other end of the spectrum, which have really been driving the economy and taking advantage of these high asset prices, particularly in stocks, but also in real estate, the cost to fill up the tank is considerably less as a percentage of their income. So I think it's a mixed situation here. What I think investors can't forget, of course, that it's not just the cost to fill up your tank that energy prices are going to have an effect on. It's also food and other things that need to be distributed around the country.
Yes, there's quite a trickle-down effect. And if the U.S. consumer is unhappy or feeling as though things are unaffordable, this is more of a political question, but what would that do for the Trump administration maybe in trying to end this war sooner to maybe drive oil prices back down again?
Well, so that's been really the strategy of Iran, is to get the American consumer on their side. And by making the economic outlook look kind of negative and pushing up energy prices, try and get the United States to back off their attacks on Iran. Not clear how successful that's going to be. I think at this point it's full speed ahead for President Trump. But on the other hand, of course, I think a real line in the sand is the wish that we do not put U.S. boots on the ground there.
Mm-hmm. And what do you think the Fed is focusing on now more at this point, like higher inflation or the kind of stronger than expected jobs report we saw come out last week?
Yes. I think it's certainly, we all rejoiced with the better than expected jobs report for March. That was completely unexpected. That does allow the Fed to focus more on the inflation portion of their mandate and less on the full employment portion of the mandate. On the other hand, of course, there is a lot of talk among commentators and even some people in the Fed that, in fact, that the inflation that could be pushing through due to the energy costs may be a so-called transitory inflation, which means they don't need to adjust radically monetary policy to try and stamp it out. If, in fact, this Iran conflict ends on its own accord in due course here, energy prices should come back down here. And so they shouldn't overreact to the inflationary implications of the energy prices.
Mm-hmm. I do want to you have some stock picks. I want to go through those. But first of all, you are favoring being overweight in certain sectors at this point. What sectors do you like?
Yeah, so certainly we like the real estate section, which has been given up for dead for many, many years now. Why is that? There's been, the work from home movement. Mortgage rates have moved up, which have diminished the appeal to start new construction and so forth. But I do think that particularly if we have this new man coming into the Federal Reserve, there will be some dovishness on the part of monetary policy that could help mortgage rates. And of course, we've been in like a 2-year slowdown here in terms of real estate and home construction and so forth. And that could be starting to end, particularly if we get some more positive sentiment as these geopolitical issues hopefully die down. And of course, if inflation is a problem, there's really no better place to be than real estate, which historically has been able to raise rents and to offset the inflationary implications.
Got it. Okay, so we'll go through some of your stock picks. Lululemon is the first one. This has been a struggling company over the last couple of months. What is it that you like about Lululemon?
Well, first of all, you got to look. This is a blue chip consumer brand name. No one does it better when it comes to athletic wear. What I like, of course, is the valuation. This was a stock that traded over $500 a share just over 2 years ago. Now, of course, it's down by about 2/3. It's even lost half of its value just in the last year. So now you got a stock that's trading about 11 times earnings. That's like 1/3 the valuation of Nike. That's just over half the valuation of the S&P 500. So why is that? The idea is it's a slow growth, that there are trade wars and so forth. But I think investors are overlooking. They're making some substantial inroads into China. The Chinese seem to love the Lululemon offerings. That could also be the case in India. And I think there have some significant initiatives in terms of efficiency, product innovation, speeding up the cycles of new offerings that could supercharge their outlook here. And meanwhile, you're getting a nice stock here, Lululemon, at 11 times earnings.
Okay, we're going to have to leave it there. We are out of time. David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Appreciate you coming on. Thanks so much for joining us.
Thank you.
Up next, a fierce price war between Canada's major telecom companies doesn't seem to be paying off. We'll break down what it means for the industry right after this. A price war between major Canadian telecom companies isn't paying off, with subscriber growth slowing across the board. And to break down the sector's challenging, tough first quarter and what it means for the year ahead, we sat down with Vince Valentini, Managing Director and Equity Research at TD Cowen.
It's quite disappointing to me. We went through 2 years of price war, and then for 6 to 9 months, it seemed like the carriers were getting back to discipline. And that seems to have all been thrown out the window here in the first quarter. And especially in the month of March, we saw some escalating pricing battles with carriers offering weekend flash sales of $25 rate plans. The average ARPU for Rogers Bell and Telus is in the $56 range. So if they're selling services at a $25 base monthly fee, that's extremely painful for their financials in the future. So we felt it was best to sort of get to the sidelines until we see some end in sight to this price war. So as you've probably seen, we downgraded all 3 of Rogers, BC, and Telus to hold ratings as of last Thursday.
And I think that's the first time you've ever done that, if I'm not mistaken, right?
I've been covering the sector for 30 plus years. I hate to say, a little more gray hair than when I started, and I've never had no buy ratings in the sector. I don't have buy on any of the cable or telecom names right now. It's a pretty challenging environment with no population growth. You really need pricing discipline, and it's difficult to have coordinated pricing discipline when you have 4 carriers. I mean, the government has worked hard to have more competition and stimulate a 4th carrier in Canada. And for consumers, that works. For the carriers who are in the industry, it's a difficult situation.
So do you think there's not room for 4 then?
They can survive. None of them are going to do particularly well. You see, the U.S. market really has 3 national carriers and probably putting up better economic results than the Canadians. That's a policy decision for a later day. I don't think this government has any appetite to change those rules, and they obviously have a lot of bigger priorities to deal with than regulating telecom these days. So I think it's just something we have to live with. So the carriers need to be disciplined with their costs. A lot of them are looking to trim non-core assets to improve their debt leverage. So I think they're taking steps to deal with the tough situation. But first and foremost, they just need to try to be a bit more disciplined than what we've seen recently on price.
And so a couple of things with the trimming the non-main assets. What are they trimming? What are they trying to get rid of?
So everybody's got their different flavor of what they're doing. Rogers obviously has a huge investment in sports, which they say is worth upwards of $20 billion. And we should see a transaction by the end of this year to bring some cash in for a minority interest in all of their teams, the Blue Jays, MLSE. TELUS has announced they are looking for a buyer for part of their healthcare business. Is probably the biggest transaction for them. BC has just announced a couple of smaller asset sales. They still own all of their cell towers. They do own a 20% stake in the Montreal Canadiens. So all of them have various things that they can raise, a couple of $1 billion at least from to pay down debt and, hopefully help them manage through the wireless situation we're in.
Could you see Rogers selling the whole package of sports as a complete package and selling all of it, or do they want to hold on to that?
No, I think Edward Rogers and the family want to retain control of the business. What we have said is possible is an initial transaction this year to sell a minority interest to a group of private investors. We actually pegged that at $6 billion is what we think they'll get. A year or so after that, there could be a flotation of it as a new public company. It would still be controlled by the Rogers family, but it would be totally structurally separate from Rogers Communications. So you have one entity that has all the sports and entertainment assets, another entity that owns just the cable and wireless business. We think that's a better way to proceed so investors can decide which exposure they want, but I don't think the Rogers family ever wants to give up control of those assets.
All right. CRTC is banning activation fees and could remove meaningful revenue. How are they going to adjust to that? That's one more curveball, isn't it?
It is yet another curveball. It's surprising to me that given how tough the industry has already been in terms of price competition and the lack of volume growth or population growth, that the CRTC would want to pile on with that, with what I deem to be micro-regulation. The industry may try to fight back against it and see if they can get that decision revised or overturned. But if not, then just yet another sort of hill they have to climb. And what they could do is say, we won't give away as aggressive of a promotion to get you to sign up. Oftentimes when you go into the store, like, hey, the first 3 or 6 months are at a discounted rate. But if they have to not charge the activation fee, they may not be willing to do that and make up that revenue in that way. But for sure, it's an extra $50 to $75 million for each of the carriers that they could lose going forward if that CRTC decision sticks.
Okay, and Quebecor, where's the new kid on the block fit in? Are they being set up to be sold, or is there space for them?
No, you really can't be sold. The foreign ownership rules exist. It'd be difficult to find a buyer in Canada, and I have no reason to think that Pierre-Karl Péladeau wants to give up control and sell. He wants to keep that in his family. So I don't think it's a sale candidate, but they're doing very well organically. They continue to add market share. Remember I earlier said $56 for Rogers, Bell, and Telus as their average revenue per wireless customer. Quebecor is only at 35, so they're at a much better starting point where even in the current price war, they're still adding customers at or slightly above what their average revenue is. So they have much higher revenue growth in wireless than the others. That's offset by a slow growth cable business. So you could argue it's the best growth name in the sector, clearly trading at a big premium valuation now. So maybe that growth is already priced in, but it's if you're just looking for growth, then it's really the only alternative in the sector.
That was Vince Valentini, Managing Director and Equity Researcher at TD Cowen. Coming up, we will hear from NASA's former chief economist about the cost of building and sustaining a long-term presence on the moon. Stay with us. As Artemis 2 circles the moon with Canadian astronaut Jeremy Hansen and 3 American astronauts, space economists are analyzing the economic drivers behind renewed space exploration and what it would take to sustain an Artemis moon base. For more, we spoke with Alex McDonald, Senior Associate at the Aerospace Security Project and former Chief Economist at NASA.
The goal of Artemis is to not just return to the surface of the moon, but actually build up a permanent presence there. So, we'll see where we get to, but the actual plan is to be able to build a habitat there, possibly multiple habitats now. In fact, last week, NASA rolled out a new set of commitments to robotic lunar landings prior to human landings, which are indeed scheduled for around the end of this decade. But they would be planned to continue through the 2030s with installation of power infrastructure, potentially R&D projects that might learn to use some of the resources that are on the lunar surface, like oxygen and water ice. So yeah, there's actually a relatively indefinite commitment that's happening here.
Is there a real economic payoff here, though? Because the moon is barren and they don't have much stuff. They don't have anything that I know of, maybe some isotope of hydrogen that isn't available on Earth.
Yeah, so the main economic benefit is really just the technological advancements that any country that invests in space exploration gets. My kind of favorite fact on that is that between 1960 and 1963, 75% of all global semiconductor demand came down to space programs.
Wow.
So basically, space programs became a way of scaling one of the most fundamental technologies of the modern world. GPS, telecommunications, satellites, space-based internet. All of these things come from investments in the space program. That is going to continue. In terms of this question of resources, the water ice is predominantly used for astronaut consumables as well as potentially rocket fuel. There is also discussion of helium-3, which is a different isotope of helium that might have use in fusion and potentially quantum computer cooling. So there's some potential applications, but really the main investment is really showing world leadership. As we know, during the Cold War, America's landing on the moon really kind of established U.S. technological supremacy. And there's going to be a similar process playing out here. China has its intentions to land on the moon by the end of this decade as well. And how and when the different countries land on the moon and the capabilities that are established will signal a significant amount of global leadership. So there's multiple different layers to the type of investments.
There have been, the original Apollo program was curtailed because of cost. And then there was another major initiative aimed at the moon, but that too was called off because of the expense.
That's correct. So we're now on our third attempt to return to the surface of the moon. Of course, right now, today, we are succeeding in the very first element of that. Today, there will be essentially a communications blackout period of about 40 minutes while Jeremy Hansen, the Canadian astronaut, and his three American NASA astronaut colleagues, Reed Weissman, Christina Cook, and Victor Glover, all go around the far side of the moon. That is happening today. And then they'll have a 4-day return back to Earth. So this has been the result of about 15 years of committed investment dating back to the 2010 NASA Authorization Act that Congress passed and was signed into law. The first attempt to try to return to the moon was the George H.W. Bush era Space Exploration Initiative. That submitted a bill to Congress of half $1 trillion, over $1 trillion today in inflation-adjusted terms. That was canceled. So what NASA did to reestablish this program was to rely on two different core strategy elements. One was to rely on international partnerships, Canada being, of course, the first country to fly as part of Artemis. But there will be other countries as well. The U.S. is committed to landing Japanese astronauts on the lunar surface. The European Space Agency is also a major partner. They actually provided some of the service module that was used on this mission. So the international component will be lowering the cost and in getting more political kind of alliance benefits as well. And then the second major difference, of course, was the reliance on the commercial sector. The two companies with contracts to land astronauts on the moon are Blue Origin and SpaceX, which are respectively owned currently privately by Jeff Bezos and Elon Musk, the richest people in the world. So there's been a very different strategy that's been taken, and thus far that has proved to be very effective at getting a sustained program going here.
Yeah, I got my helium and hydrogen isotopes mixed up there for a second. Has Elon Musk, with his rockets, has he significantly lowered the cost of getting people into space?
So he has significantly lowered it, but not necessarily as much as people might realize. In fact, some of NASA's costs actually are going up. Where he's really succeeded is creating a vertically integrated company that has managed to use this capability to reuse rockets to launch his own Starlink satellites and create the largest constellation of satellites in history. So the cost has been reduced, but not necessarily by the many orders of magnitude that people have hoped for. Of course, Starship is looking to reduce the cost even further. If that vehicle is fully successful, it will be fully reusable, and the hope then will be to be able to reduce the cost of spaceflight by perhaps another order of magnitude. So we are seeing significant reductions in cost. We're seeing, perhaps even more importantly, significant increases in the number of launches. We're now up to 100 plus launches a year. This is the highest there's ever been. So we're really at a boom time in terms of space launch and particularly in terms of satellite production. We're now at well over 10,000 satellites in space. 75% of them are in fact owned by SpaceX for the Starlink satellite constellation. So there's certainly a lot more activity going on now than there's been in a long time.
That was Alex McDonald, Senior Associate at the Aerospace Security Project and former Chief Economist at NASA. Up next, we've got the latest Nanos research data, which indicates declining consumer confidence among Canadians due to rising energy prices. We'll speak with Nick Nanos about that when we come back. Stay with us. According to Nanos research, Canadian consumer confidence has reached its lowest point in nearly a year, driven by the war in Iran, rising energy prices, and concerns about ongoing inflation. Only 15% of Canadians expect a stronger economy in 6 months, which is down from 27% 4 weeks ago. So let's get more now from Nick Nanos, Chief Data Scientist at Nanos Research Corporation. Nick, it's good to see you. Thanks for joining us.
Good to see you too, Lindsay.
So when we last spoke, consumer confidence was at its highest level since late 2024. To what extent are the rising gas prices the reason that we're seeing such a disruption in this confidence?
Well, the thing is that we do know that people are very sensitive to the price of gas. And we've seen a rise in the price of gas since the war and the war between the U.S., Israel, and Iran. And it's just clear when we look at the consumer confidence numbers that Canadians feel that they are just getting hammered. And consumer confidence has been on a clear negative trajectory for the last number of weeks. And I think a lot of that has to do with initial reaction to something like the price of gas, which many people need in order to get to work.
Yeah, because it's been such a change around, kind of a turnaround in the last 4 weeks, which is pretty quick to see such a drop in confidence, right?
Absolutely. And, the thing is that we've gone from being in a positive territory where the score is above 50 into a negative territory where it's below 50. And, the thing is this net negative consumer confidence score suggests that, Canadians might be kind of starting to kind of batten down the hatches, so to speak, because even when we ask Canadians on whether their personal finances are better or worse off compared to a year ago, only 13%, Lindsay, say that their personal finances are better off compared to a year ago, while a significant 41%, or 4 out of every 10 Canadians, report that their personal finances are worse off compared to a year ago. And it speaks to the environment, the consumer environment that we're in right now.
Wow. And when you break it down province by province, Ontario appears to have the lowest sentiment among all the provinces. What's driving that?
Well, you know what, Lindsay, a lot of that has had to do with anxiety related to the free trade relationship with the United States. It's kind of, it's definitely top of mind for many Ontarians when we think of sectors like the automotive sector, which is one of the key sectors in Ontario. And, what we've seen, usually Ontario has the strongest consumer confidence. Now we're seeing a reversal of that in this environment of trade uncertainty, where Ontario now has weaker consumer confidence than it has traditionally and also comparatively to other parts of the country.
Wow. Are you surprised that the 18 to 29 age group reports the highest consumer sentiment among all the age demographics that you surveyed?
Yeah, it's been a bit of an improvement compared to earlier on this year for Canadians that are younger. The other thing is that when we look at the demographic data right across the board, almost everyone over 30 is reporting kind of consumer confidence in negative territory. What does that mean? That means that people with families are being squeezed, middle-aged Canadians are being squeezed, and even Canadians that are over 50 and 55 years of age are kind of starting to feel the squeeze. And I think for younger people, they're just starting to feel a little better than they have been over the last while.
What about when it comes to homeowners and renters? Like, what's the data showing there in terms of their consumer confidence?
Actually, not a big difference when it comes to homeowners and renters. But, on the real estate front, what's interesting is that when we ask Canadians whether they think the value of real estate will go up or down in the next 6 months, it's almost a wash. About 31% or thereabouts, I think, believe that real estate will increase in value, while about 25% say it'll decrease. So no difference based on homeowners and renters, or significant difference, but kind of almost like neutral territory. 39% no change, 31% increase, 25% decrease. And usually real estate has been a positive outlier. It's been driving a lot of consumer behavior over the last 10 years, not so much lately.
Wow. Okay. So when it comes to some of the factors behind this, like we talked about the rising energy prices, you mentioned specifically for Ontario that there's a lack of confidence, I should say, when it comes to the ongoing trade war between Canada and the U.S. What are some of the other reasons that Canadians are giving for their skepticism?
Well, what's clear is that there's a bit of an accumulation effect taking on because, when we ask Canadians what the top things are that they're worried about, and we ask this every week on the same survey that we do with Bloomberg News, at the very top of the list is worry about jobs and the economy. Also at the top of the list is worry about trade. And people specifically mentioned Donald Trump. After that is inflation. So think of an accumulation effect. We've got a rise in the price of gases. People are worried about the price of housing. They're worried about the price of food, and they're worried about their jobs and the trade relationship with the United States. And what we're seeing is we're at a moment in time where all these things are starting to pile up. It's kind of like, Lindsay, where's the good news? I'm not sure there are any real bright things right now that might make Canadians feel better about the future economically. And it speaks to this negative slide, this negative trajectory that we're on right now.
You kind of answered my last question. I was going to ask if there's any specific factors that could give Canadians some optimism amongst all of this.
I don't know. Are you hearing crickets, Lindsay? I'm hearing crickets. Not a lot right now, but the thing is we'll wait and see what happens. There will be in July, there will be kind of a key benchmark for the discussions with the United States on trade. We don't know what'll be what's intended in that, but I think right now it's on a negative trajectory. Not saying it can't change, but it's trending negatively right now in terms of consumer confidence.
As you say, things can change very quickly, though, so we'll leave it at that. That's Nick Nanos, Chief Data Scientist at Nanos Research Corporation. It's always good to have you on. Thanks so much.
Bye-bye.
Up next, U.S. President Donald Trump stated today that Iran has until 8 p.m. tomorrow to agree to a ceasefire and open the Strait of Hormuz. If these conditions are not met, he has indicated that attacks on Iran's infrastructure will escalate. We'll be back in a moment with more on that. As the U.S. deepens its involvement in the Middle East, the cost of fighting is climbing, drawing criticism from lawmakers. Bloomberg's Shaquille Amari explains how much the war could cost American taxpayers if it continues.
From a barrage of strikes to more troops on the ground, growing tensions in the Middle East are leaving American taxpayers to foot the bill. Some critics not in favor of President Trump's decisions.
He took us into this war in Iran without a clear plan, and it's costing us billions of dollars a day.
To date, the conflict has cost more than $25 billion a week, $11 billion spent just in the first 6 days. With troops on the ground, Bloomberg analysts estimate costs could climb between $15 and $20 billion a month. For perspective, Operation Iraqi Freedom carried a lower monthly cost, between $8 and $15 billion. Total cost topped $806 billion, according to data from the Center for American Progress. Occupying Iran's Karg Island could drive monthly expenses up $10 billion more, costing up to $30 billion a month. To cover further expenses, the Pentagon is planning to ask Congress for $200 billion.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys.
President Trump says he predicts ending the war on Iran within 2 to 3 weeks. The U.S. defense officials say the key details about U.S. military spending, including planned budgets for services, will be released on April 21st. Shaquille Omari, Bloomberg News.
We're doing unbelievably well, well at a level that nobody's ever seen before. The entire country can be taken out in one night, and that night might be tomorrow night.
That was U.S. President Donald Trump, of course, who earlier today at the White House informed the media that if Iran does not meet his self-imposed deadline of 8 p.m. tomorrow to open the Strait of Hormuz, he will escalate strikes by targeting Iran's civilian infrastructure. Some strong words there. So let's get more now from Arman Mahmoudian, research fellow at the Global and National Security Institute. It's great to have you join us. Thanks so much.
Thank you for inviting me, Lindsay.
So if the U.S. president does approve strikes on Iran's energy infrastructure tomorrow night, how significant of an impact do you think that would be for Iran, and would they be able to retaliate?
I think it's going to be a very significant, change of event. It's going to, transfer the current escalation, which already reached a peak, to a new era. Because Iranians have already threatened that in an event of an attacks on their power plants, on their water destination and oil refineries and oil and gas fields, they would do the same to the Arab nations of the Persian Gulf. And to be honest, the main thing that so far withheld them to launch such a large scale attacks against those targets of their neighbors is that the fact that they knew if they do so, they would face the same attacks from the United States. But if the United States moves toward attacking and bombing Iran's power plants and basically bringing dark and fury upon Iran, as President Trump promised, the Iranians don't have much of a deterrence ahead of themselves to not do the same thing. And I believe that President Trump also understands the issue. He understands the Iranian still possess the capability and capacity to do so. Iranian attacks against the LNG in Qatar about 2 weeks ago, which shut down about 17% of Qatar's production of the gas, prove that they still have some capability to project such attacks, specifically speaking, given the proximity of between Iran and these nations. Iran only needs to rely on its short-range arsenal, which Iran has a volume and abundance of in terms of the number of the unavailable projectiles to it.
Donald Trump has said that he's seen Tehran's counterproposal and described it as, quote, not good enough when it comes to reaching a ceasefire. Are you optimistic that there could be a ceasefire reached before tomorrow night?
To be honest, it depends on to what extent both President Trump and Iranian leadership want to compromise. President Trump is interested, I believe, in a ceasefire rather than a peace deal. He, at this point, because of the pressure that he faces from the U.S. partners and the domestic pressure that he feels, specifically speaking, due to the rise of the price of the fuel and gas, he wants to open the strait. He wants to have a ceasefire to let the flow of the oil and gas be universal once again. This, in a view of the Iranian, is actually quite a dangerous scenario. Iranians are not really interested in a ceasefire. They want a peace deal. They do not want a ceasefire because they believe in an event of ceasefire, this war would be only one episode or another episode of the confrontation between the United States and Iran and Israel. There will be another one. They want a peace deal. They want a security guarantee. But in order to get the security guarantee, they need to make concessions that they are not also ready for. The Iranians are not ready to make concessions regarding the ballistic program, regarding the regional policy, because what they realize in these two wars from the June and the current war is that all they have to deter their enemy or to defend themselves or to retaliate against their enemy is actually their ballistic program and also to lesser extent their regional allies. So they cannot give that up, because if they give that up, they would basically defenseless themselves. So we are in a kind of a dilemma in which we know it's going to be very hard to predict what is going to outcome of it. And it requires a great deal of concessions, compromise, and also to some extent sacrifice.
Yeah, it's been interesting to watch. Like over the weekend, Iran demonstrated its continued ability to target critical infrastructure in the Middle East. It also shot down a U.S. fighter jet. How does this impact the claim by Trump and many members of his team that Iran's military capabilities have been degraded and that the war has already basically been won?
I think President Trump's is, when he makes such a statements and he gives such figures, he mostly is trying to aim at his own domestic base rather than to presenting a data or, presenting a clear military image. As you mentioned, that the events that happened yesterday and the day before that in Iran, shutting down an American F-15, shutting down apparently 2 helicopters, shows that Iran still possesses some level of the capability and capacity to hurt back and to defend itself. So it's not basically defenseless. And I believe President Trump now realized that. However, I want to point out there is a chance that actually the Americans have made a misunderstanding or underestimated the remaining of the Iranian capabilities. One of the reasons that, in the last 48 hours, we witnessed the Iran's counter strikes against the U.S., aerial subjects over its outer space, including the F-15 and the helicopters, could be that Americans and the Israelis being a bit overconfident. They kind of trusted that Iran has nothing left to defend its aerospace. So they functioned and operated with a higher level of the confidence, which means lesser level of the cautions, and that got to them the fiasco of the last 48 hours. But what we have seen in the last 48 hours, and also from the continuous of the Iranian retaliatory campaign, Iranian has been launching missiles and drones in the same tempo, at least in the last, let's say that at 3 weeks. There was a decline in the number of the missiles and drones that they launched on 3 weeks ago, but since the volume and the tempo of the attacks is the same, so Iran still has a capability. Iran is weakened, there is no doubt about that, but still is dangerous and can be lethal.
Okay, we'll have to leave it there. That's all the time we have. Armand Mahmoudyan, Research Fellow at the Global and National Security Institute. Thanks for joining us. Appreciate it.
Thank you for inviting me.
Up next, legal AI company Harvey hits $11 billion US in valuation and plans to expand its presence in Canada. We will speak to their CEO right after this. Legal AI company Harvey has hit a valuation of $11 billion US with its latest round of funding, which raised $200 million. The American company plans to scale rapidly and invest in agent-driven legal work, and Canada is a big part of that plan. So let's get more details now from Winston Weinberg, CEO and co-founder of Harvey. It's great to have you join us. Thanks so much.
Yeah, thanks so much for having me.
So I guess for our viewers, first of all, or people who maybe never heard of Harvey, can you tell us some of the key functions that Harvey provides to its clients?
Yeah, so we're a legal AI operating system. So we help with drafting, reviewing documents, and we're starting to get to the point where we're releasing agents that do actually full end-to-end work. So something like a diligence or a discovery actually from start to finish. And the agent will look closer and closer to kind of like how you'd be working with a colleague, where it asks you follow-up questions, it asks you for a plan, it will say, hey, did you mean this or did you mean that? It'll ask for more context and really kind of pulling the context out of the user in order to create a better work product.
So Harvey raised $200 million US in your latest round. How much have you raised in total so far?
Over $1 billion.
Over $1 billion. What are you using the funds for?
Yeah, so rapid development across product. So what's starting to happen now is with the advent of the coding models, you can kind of parallelize your production teams. So we have a lot of pods of different engineers, and this is part of why we're so excited about our Toronto office. That's an incredible and talent hub for engineering. And you can basically have different pods build all of these things in parallel. So a lot of it is expanding the product. And then we also global expansion. So we operate in over 60 countries.
Okay, I do want to talk about your Toronto office and your expansion into Canada in particular. But first of all, I just wanted to talk about your kind of valuation over the last couple of months. You were valued at $8 billion US last December, now stands at $11 billion. How have you become so much more valuable in such a short amount of time? Like, what has your company been doing?
Yeah, I mean, almost all of this is product development. So what you're starting to see is a pretty large difference in how folks are using these tools over time. And again, I think this started, with a lot of engineers using the coding models kind of, it started maybe with monthly and then weekly, and then it's gone to daily. That's starting to happen in legal, right? So you used to have lawyers that would log into these products maybe once a month or once a week. And now we're getting to the point where a very large proportion of our users are using it for kind of most of their work throughout their day. And when you see that happen, you get pretty massive growth in revenue, but you also get a lot of growth in actually the stickiness of your platform, right? If folks are thinking of it more as an operating system and something that they log into every single day, your company becomes a lot more valuable because the product is a lot more valuable to the users.
Got it. Okay, and so not to take away from your efforts, but it's also like the market has been shifting rapidly as well, right?
I think the capabilities of our product is just getting better and better, right? And I think that is part the capabilities of the product and part also, lawyers are a lot more interested in using AI, right? And if you think back to kind of 3 years ago, it was pretty hard to get lawyers to actually log into these products and see the benefit of them. And now I think most folks have said, oh, okay, across all of knowledge work, AI is going to be a huge impact on my work, and I'm going to start using these things daily. And so it's a combination of the product is getting a lot better, plus just overall, I think knowledge workers are much more willing to try these things and actually change how their work processes go.
For sure. Okay, so tell us about the Toronto office and just Canada as a whole and how that fits into your expansion plans.
Yeah, so we opened up the office in Toronto last October, actually. It will probably be about 30 people by the end of this quarter. It really mostly is kind of just an incredible engineering hub. So a lot of that office is actually, they've been critical in building things from 0 to 1. So one of the things we launched last year is called Shared Spaces, which is basically a collaboration part of our platform, so the in-house teams and their law firms can actually work in the same Harvey instance. And they were actually the ones that did the 0 to 1 process on that team out there. So it really is just an amazing talent hub. We're going to keep growing it, and it will definitely be engineering focused, but we'll grow other roles as well throughout time.
Have you heard any feedback yet from any of your customers, particularly maybe like Canadian customers, about the advantages of using AI in this way?
Yeah, so we have a lot of Canadian customers, like some of the law firms that have been public about it is Gowling and Davies. And I think that the law firms are thinking about it in a way that will drive like new business. So I'm seeing increasingly kind of month over month, a lot of your pitches, right, to an in-house corporate really revolves around, hey, how are you going to use AI to actually produce a better work product for me, make it so I can review all these documents faster, especially in transactional work where, time kills almost every single deal. And so a lot of law firms are pitching, hey, these are huge efficiency gains and we can get this work done faster if you go with us. And so it's helping them gain new business.
What are some of the risks? Like, are there any problems in terms of adoption, integration, or any other risks that Harvey foresees in the future?
Yeah, I think in general, one thing you have to bake into these products is as they get more agentic, you need better ways of auditing it and reviewing how the work got done, right? So if you think about, maybe a year ago, most of this work was chat-based, and you could kind of see, okay, what are the steps that the agent took to do the different pieces of work, because they would answer it in under a minute or something like that. Now we're getting to the point where we're launching long horizon agents, and those agents can be working for a very long time. And so all of the products need different ways to audit all of the outputs so you can see what the agent is doing. And I think that over time, as we get to more and more complex work, like an entire diligence or entire litigation, that auditability and governance is going to be really, really important to the success of our company.
Okay, we'll have to leave it there. Winston Weinberg, CEO and co-founder of Harvey. Appreciate your time. Thank you.
Thank you. Have a great day.
You too. Well, a NASA crew of 4 astronauts is set to fly by the moon at the closest distance they will get to the lunar surface during their mission, and the nearest any human has gotten to the moon in more than 50 years. For more, we are now joined by Bloomberg's Lauren Grush to break everything down. Lauren, it's great to see you. Thanks for joining us.
Thanks for having me.
So I'm not sure if you can give us kind of more up to date in terms of where the crew is right now. We heard an emotional speech from the crew earlier today. What's happening now?
Right. So a little before 2 p.m. Eastern is when they really made history. That's when they broke the distance record previously set by the Apollo 13 crew in 1970. And so now they are officially the 4 humans who have traveled the farthest into space out of any of us. So they've already broken that record. And then later this evening, they will have a communications blackout once they pass around behind the moon. And then after that time, they will reach their closest distance to the lunar surface, which will be about 4,000 miles. It's definitely not as close as the Apollo missions got. The moon will appear to be about the size of a basketball in your outstretched hand in the capsule window. But still, that's closer than I've ever been. So it's certainly something to write home about.
It's pretty amazing. Tell us more about that communications blackout, because it's going to be about, 40 minutes, I think you said. And the crew obviously has to do most things themselves anyways when they're up there. But with no communication for that length of time, that's pretty significant.
Yeah, it's 40 minutes, but this is pretty standard for moon missions. It happened during the Artemis 1 mission, which was an uncrewed kind of dress rehearsal for this flight. Happened during the Apollo missions. It's just when the capsule goes behind, on the other side of the moon, and the moon is blocking the line of sight with Earth. And so it's a pretty standard procedure. It's a little eerie for us here on Earth because we can't hear them, but it's probably a nice moment for them because they get some, some privacy to be with the moon during that time.
So interesting, Kate. Lots to watch for the next couple of days, and especially tonight. But we'll leave it there for now. That's Bloomberg's Lauren Grush joining us live. Thanks so much, Lauren.
Thanks for having me.
And here's what's happening on Bay and Wall Street. We'll take a quick check before we end the day. Of course, markets closed about half an hour from now. They closed half an hour ago. TSX, S&P 500, NASDAQ, all finishing the day trading up. And that does it for today's program. Thanks so much for watching.